at the height of the last cycle, we saw the major gold producers trade at 2 times their spot PNAV. Even the biggest gold producers, the most notable ones right now, are just a hair above 1 time. So I think we still have a long way to run. You can have these extraordinary periods, one of which we're in right now, which is a generational time to be producing gold. We haven't hit that euphoric frenzy yet, and there's still a lot more money to be made in the gold price.
With gold approaching $4,700 now, it's at $4,676 is the latest number on my screen. On the 19th of January, we're going to talk about what is going on with the entire metals complex and what is going on with gold next. Well, gold's had a tremendous run, and we're going to figure out whether or not this is the beginning of a bigger bull run even still, or perhaps momentum could be fading soon. Stephen Soock joins us today. He's the VP Investor Relations and Development at Heliostar Metals. Welcome to the show, Stephen. Good to see you again. Or good to see you. It's your first time on the show. I'm used to saying that to recurring guests, but it's your first time, hopefully not the last time. So we're going to go over Heliostar's project. Very exciting company and very exciting project. But first, tell us about what you're seeing right now in the industry. Gold at almost at $4,700. You've worked at banks before, prior to being on the mining side, so you're very well versed in analyzing trends, macro and finance trends that push prices towards the direction that they're heading now. So how is this cycle different than 2011? Let's start here.
Yeah, I think the first way it's different is just the magnitude. Obviously the move up in the gold price and the whole precious metals complex has been astounding, the rate at which it's reached these levels, I think. And I think sustainably as well. We've seen this, the gold price, especially take a few breathers along the way, put in some new bases, let investors get comfortable with where it trades, and then continue upwards from there. So I think that's what I like to see, and why we're comfortable that gold is going to stick, maybe not at spot right now all the time, but around these levels. I think it does set a bit of a new normal that I would be shocked if we see, a 3 handle on the front of gold price anytime soon. So I think that's how it's a little bit different. I think the other way that it's a little bit different too is just the ongoing uncertainty globally. In 2011 we had a steady global order, let's call it. Now, love him or hate him, one thing I think we can all agree is Trump is unpredictable. You never know what's going to come out next, and I think that's where this most recent move in the gold price has come from. Comments on additional tariffs that seem to be shoot from the hip and come and go, and then the talk of Greenland, and that sort of uncertainty gives investors some pause and want to move some of their money into traditional safe haven assets. And gold is the original money, is the original safe haven asset, and is providing investors with that sort of protection from the volatility that Trump comments can make and drive in the broader market.
Okay, so this is a geopolitical driven rally versus, let's say, demand for, I guess, other reasons in the past, Stephen?
I think the current move is geopolitically driven. Those you typically see spikes a little bit on the geopolitical uncertainty. But I think, we're still seeing the effects of the money printing through COVID. I think that's really what, from a longer term perspective, why gold is up around the $4,000 level. We printed a bunch of money globally. Gold is you can think of it as more of a currency than a commodity outside of that fiat system. And we're just now seeing the effect of all that fiat dilution, and that's being reflected in a high gold price priced in US dollars. So I think we're still catching the tail end of that. I think we're also seeing a little bit of inflation has come back into the mainstream narrative, and certainly also the Wall Street narrative. And gold is a traditional inflation hedge. So as inflation, continues to be a worry at the back of investors' minds, it brings gold to the forefront of their mind. And I think that's, again, why we've seen gold prices come up. The other reason why we've seen gold prices come up to where they are today.
How far is this rally going to go? That's what everybody wants to know. We don't have a crystal ball, but let's just walk through your thought process here.
I think I see more reasons for it to go up than dramatically down. That being said, like I mentioned, there's volatility in the gold price too. Anything that's a spike driven by geopolitical uncertainty, tends to fade over a couple of weeks as that whatever that event is becomes normalized or moves out of the news cycle. However, we are, looking down the barrel of probably a lower interest rate regime through the end of Powell's regime, and then likely sounding like it'll be a fairly dovish Fed president that comes in, or chairman of the Fed that comes in after. So, lower interest rates are typically good for gold. So I think that gives you more reason for gold to go up. We are seeing a bifurcating global world with some of the BRIC nations on one side and the Western nations on the other. And that's another dynamic that's been steadily in the background, where we've seen China specifically and most notably bring up gold as a percentage of their treasury. But across the BRICS, or the 52 BRICS plus nations as a whole, have been steadily increasing their holdings of gold as a percentage of central bank holdings. And I can only, gold has always been the backing of money one way or the other. If there is going to be a new alternative global reserve currency compared to the greenback, it's going to be backed by gold. And I think we're starting to see the effect of that thinking, again, backstops some of the movement in the gold price.
There are some narratives out there in terms of, some theories as to what gold may signal every time it spikes up dramatically, and what it's done in the past we can extrapolate to present day. In other words, some people say that the gold price going to where it is today signals a collapse of the US dollar, or even just a major downgrade in its value. Or perhaps it signals much, much higher inflation, which I guess may be the other side of the coin for a weaker dollar. I wonder if any of these theories make sense to you. Does it necessarily have to mean either or of these things, or perhaps something else, Stephen?
I think I agree on the inflation comment. Gold has always been a bit of a leading indicator of inflation, especially in the gold mining market that I'm in. We see, the way I think of it is as a slinky. You see periods of margin expansion where gold price runs, and then eventually costs come up so that percentage margins are fairly static over time. That being said, you can have these extraordinary periods, one of which we're in right now, which is a generational time to be producing gold, where you get just these very wide margins, where you've seen the gold price run up and inflation hasn't caught up yet. So I think I agree that where gold price is now is a leading indicator of inflation, and something that, frankly, investors should continue to be a little bit concerned about. Even though we haven't seen it hit the CPI and kind of traditional metrics yet, but I think Main Street is feeling the crunch a bit, and eventually we will see inflation catch up across the board, when we will see those margins compress. However, being able to capture that margin as a gold producer right now is incredible.
Look, going back to 2011, a lot of mistakes were made in the industry when gold was peaking at its time. And I just want to know what exactly was going on in 2011. And I think from a gold investing standpoint, people may be looking at this cycle and the financing activity or drilling activity or just corporate development in mining as an indicator on whether or not this cycle is peaking as well. So can you maybe draw any parallels whatsoever?
I think we're still not quite early. Sorry, I was going to say quite early. I think we're midway through the cycle. We're certainly not at the height of it yet. Speaking with investors, there are gold bugs that love investing in gold stories and exploration stories, and they're there cycle in, cycle out through all parts of it. The more interesting comment is the fact that we're just starting to see generalist investors, both on the retail and institutional side, come in a more notable way to gold holdings and gold equity holdings, who have been largely absent over the better part of the last decade. As a result, as you mentioned, of some of the mistakes made in 2011. Again, those sorts of players are just starting to nibble around the edges. They're not starting to really jump in with both feet yet. And I think you've really got to see that happen in full force before you can say that the cycle has peaked. The other thing to look at is, while gold stocks have been up, overall equity valuations on a multiple basis are still reasonably low. The metric we look at is a price to NAV traditionally, and NAV priced at spot gold. So spot PNAV is the term. At the height of the last cycle, we saw the major gold producers trade at 2 times their spot PNAV. Even the biggest gold producers, the most notable ones right now, are just a hair above 1 time. So I think we still have a long way to run. As you move down cap from the Newmonts and Barricks and Agnico Eagles of the world into the junior producer space, you're still only seeing spot PNAVs at around 0.3. So I think that still tells me that there's a lot more room to run. We haven't hit that euphoric frenzy yet, and there's still a lot more money to be made in the gold space. Excuse me.
I've seen some sell-side banking reports on certain companies, and some analysts are still using gold at $3,000 as low as $2,500 as their NAV assumption for their base case. Is there a particular reason why some banks are still very conservative? Is that just part of their methodology, or are they actually anticipating gold to retrace back down to 2,500 to 3,000, do you think?
I mean, I can't speak for everyone,
Sure.
but I think I find it very hard to see how gold goes back to $2,500 an ounce
Sure.
myself. Taking a conservative view of the long-term gold price is part of the methodology that big banks use. Speaking as a former research analyst, I can tell you that we typically use too low of a gold price compared to spot or even the forward curve. Conversely, we also use too low of a discount rate. The industry standard is to use a 5% discount rate, which is unachievable. If someone's offering you 5% money, jump on it. But usually that cost of capital is closer to the mid-teens, let's say, for an average gold producer. So the two kind of offset. If you look at the effect of a too low, if you were to use a realistic discount rate and then a realistically higher gold price, the two kind of do offset. So again, it's part of the methodology. It gives big banks some cover when things do eventually, have a bit of a pause or a pullback, but still allows them to kind of show what the value is in these companies that they like to highlight.
If you were still working as an analyst, let's say you were on a call with let's start with the larger producers first, and then we'll talk about the explorers like Heliostar. What are some of the first questions you would ask a producer on an earnings call, let's say? With gold at $4,700, almost to $4,700, what kinds of assumptions would you have to build into your model in order to project their cash flows from here on out?
I think something I'm always been interested in from a company side is, you do your long-term projections and your long-term capital planning and strategy. But then at a current gold price, there's opportunities that appear. Something that, in your model or geologic model that you did at, maybe $3,500 an ounce, but you'll be mining next month at closer to $5,000 an ounce, or have the opportunity to mine next month at $5,000 an ounce. What are those opportunities that you're seeing in terms of, let's call them tactical opportunities? That's the sort of question I'd ask in this gold price environment. The other thing I think is worth always asking is, what are you going to do with the money? Certainly there's a lot of extra capital that's being generated right now, especially by the major producers that are the multi-million ounce per year producers. Do they have growth projects that they're excited about and think can add value to investors by investing in? Are they increasing or issuing an initial dividend and repaying investors for their longstanding loyalty? Are they interested in M&A, and are they seeing opportunities in M&A and to deploy that capital externally? As you mentioned, one of the mistakes of 2011, that there was a rash of overpayment at I think we could all agree is close to the peak of the last gold cycle. So I think the major producers are a little more disciplined and probably rightfully so a little more gun shy of some major M&A. But it's always got to be on the table, right? If you're a 2 million ounce a year producer, that means you've got to replace 2 million ounces a year every year somehow. And I think M&A has to be part of the conversation. So again, the money they're making at today's gold prices, what do you plan to do with it?
So let's take Heliostar as an example for the mid-tiers. You're approaching mid-tier status, I believe, 772 market cap is the last number on my screen. Correct me if I'm wrong, Stephen. And
that's right.
Yeah, you got projects operating in Mexico, which we'll talk about. So how do you set your production guidance given how far gold has run already? In other words, do you as a company dramatically change your production strategy as soon as the price of gold, the underlying metal, changes in either direction, especially to this extent?
I would say largely no. That the production is set by technical constraints. We have a mine
Okay.
plan. We have what's accessible to be mined this year. We have fixed processing infrastructure that can only produce at such a throughput rate. So it's less around how much more we can capture in this gold price environment, and more what can we capture given the plan that we've engineered to that we plan to execute to. That being said, in today's gold price, kind of like I was talking about those tactical opportunities, we do look at other things like that. There's a pod of mineralization that we weren't sure about when we were running scenarios at $3,000 gold. If we were looking at mining this, within the next 18 months to 2 years, and are highly confident the gold is going to be closer to where it is now than $3,000 an ounce, how do you execute on a strategy to bring that into a production plan over the short to medium term? So that's the sorts of things that have entered the conversation more again at $4,500 an ounce gold. But certainly we're looking at every opportunity to capture additional production where we can right now, because that margin is so wide for us.
At what point do you start thinking about acquiring other deposits from perhaps other companies or just expanding?
Yeah, we are definitely a growth company, so we're always looking at expanding, both organically and by varying degrees inorganically. Inorganically, I'd say on the M&A front has gotten a little more challenging. With the price of gold going up, the price for assets has gone up as well. So you've got to find the right asset for the right price. That's the right fit for the company. We don't want things that are too small. We could probably find another, call it 10 to 20,000 ounce a year asset or producer we could tack on, but is it worthwhile in kind of our corporate growth strategy? Conversely, we are, like you said, mid-tier, so we're not going to be able to buy a 500,000 ounce a year producing mine from, Barrick or Newmont. So it's finding those things that are the right fit, that are the right expertise with our technically driven management team. Are for sale is the other one. Sometimes when gold price spikes, things that were for sale 2 years ago aren't anymore, because the operator is happy to continue to kind of reap the benefits. Organically, our growth pipeline organically, we have laid out, and we have a series of projects that we look to execute on sort of a bootstrapping strategy, taking small scale production that we turn into cash flow, that we turn into more meaningfully scaled production, larger cash flow, and so on and so forth. So we looked at a series of projects at our La Colorado mine that have allowed us to do this sort of stepwise growth. And then bring on our new mine, San Agustin, which just restarted production, last month. The cash flow from those two assets will fund an additional open pit expansion, which will then fund our brand new mine we hope to bring online called Ana Paula, which is really the key asset for the company, and will be a major cash flow generator when we're able to bring that online at 100,000 ounces a year in 2028.
All right, so here's a map of some of the projects that we're currently operating with. And black is exploration, development is green, and then operations are blue. And so when you've got a map of, let's say, one country here, in this case Mexico, and like you've explained, several ongoing projects and operations, how do you, as a company, decide which to prioritize in terms of growth and sustaining operations, or which to expand? If you're given, let's say, $10 million of capital, how would you allocate that capital? What's the decision-making process here for a company of your size?
I think the first thing we've looked at is how to look at growth opportunities that limit the near-term CapEx requirement outflow and can maximize near-term cash flow. That has kind of been our mantra over the last year. What are these smaller opportunities that allow us to generate cash to be able to move forward? And what we're moving forward towards is our Ana Paula project. That is really the cornerstone of the company. And it is such because it's tough to find an undeveloped asset with economics as good as Ana Paula. So we want to bring that into production as fast as possible, generate cash flow from our two producing mines, so we're able to fund the equity component of the Ana Paula build with internally generated cash flow, limiting or eliminating any equity dilution alongside a debt or project finance facility. So that's kind of what the focus has been, is being able to look at small scale growth opportunities with limited cash outlay that are able to have a near-term return that can help us bring Ana Paula into production. As I was saying, 100,000 ounces a year at a $1,000 all-in sustaining cost, and just exceptional economics when we're able to bring that online in the second half of 28.
And what is your, I guess, capital structure priority when raising capital? Debt, equity, you mentioned internal funding first, but if that's not enough, where do you source your capital then?
Our first priority is to limit equity dilution.
Okay.
We have 300 million shares outstanding on a fully diluted basis right now, and that's a number we'd like to keep static. We'll increase our production profile from around 35,000 ounces of gold last year that we produced up to 300,000 ounces by the end of the decade. We want to be able to 10x our production on our current share count and reward shareholders by not having them suffer market cap growth with no share appreciation, as can be the case when you have too much dilution. So that's really core to us. So in line with that, we then look at, from a capital needs perspective, debt or project financing facility, which we will need a degree of to fund Ana Paula, alongside our internally generated cash flow, which is, very, very cheap source of funding at today's gold prices. And again, never say never. If we may issue equity if we're able to do the right acquisition to grow faster. If we're able to add ounces cheaply into our pipeline, those are the sorts of things we'd issue equity for. But our growth plan, as we've outlined it right now, does not require us to issue any equity to get to that 300,000 ounce a year mark by the end of the decade.
You do have an exploration project in Alaska, and the first thing I've noticed is obviously it's nowhere close to your central operation. So why Alaska?
This was, it's become a bit of a legacy asset for us. This was actually the asset that Heliostar was founded on in late 2020. It's an exceptional asset, actually. It's a very good project. The history here is that it's remote, as you can see. So to mobilize an exploration program, you need to put a notable amount of capital in at one time to justify your mobilization and demobilization costs. It requires about 8 to 12 million a year to make it, quote, worthwhile. In 2020, 2021, the market was not there for junior exploration stories, single asset junior exploration asset. So we weren't able to fund it to the degree that it deserved. Realized that it was going to be very tough to continue down that path. Our CEO, Charles Funk, then made the decision that we needed to pivot, and that we could buy a development asset more cheaply than we're going to be able to add ounces with the associated equity dilution to Unga. Now, Unga is 300,000 plus ounces at 13 grams a ton, all located on tidewater, probably with visibility to 1 million high-grade ounces. So it's a great project. It's become a little bit orphaned as the company has shifted its center of mass to Mexico, obviously, but it's still something we really like, and we want to find the right way to move forward.
Well, I'm curious how the company transitioned from an exploration project in Alaska, which you said was the genesis of Heliostar, to the rest of Mexico. How did that transition take place? At what point did management say to themselves or make the decision to expand beyond the remote regions of Alaska into Mexico?
That sort of opportunity, usually comes down to relationships, who between both industry contacts and on the banking and brokering side. So this was something that came across, our CEO Charles Funk's desk. We initially bought the Ana Paula asset. That was the first one in Mexico we bought. And it came out of a company called Argonaut Gold. Argonaut Gold was partway through building a large gold mine in Northern Ontario, and starting to struggle a little bit with it. So they're looking to divest non-core assets. They'd sat on Ana Paula for, I believe, 5 or 6 years, hadn't really done anything with it. They'd tell you the same thing. We saw this as an opportunity where we took a completely different technical view than Argonaut, different theory, different model, and said, yeah, we'll pay you, $10 million upfront for this. $20 million in milestone payments thereafter. And they said, yeah, okay, we're not doing with it. That's 10 million bucks we didn't have before. That then became the core focus for the company. And we progressed on that view to be able to see it as a high grade bulk tonnage underground mine. As you continue down the path, we worked on that steadily for a year and a half. Argonaut continued to struggle with their mine build in Northern Ontario. They were building it through COVID. They had a few operational missteps. What was supposed to be a 350 million capex project ballooned to more than 1.2 billion. Essentially blew up the company. Didn't officially go bankrupt, but shareholders revolted and were told the board management to wind down the company. They sold Magino to a group called Alamos Gold. Then they had another asset in Nevada and the Mexican assets. Now, in order to sell the Nevada asset, they had to separate it from the Mexican assets quickly for just regulatory approval reasons. They're already familiar with us as a team. We were already familiar with them. We had a view that Mexico, the permitting regime in Mexico, was going to improve. We said we'll take these assets in Mexico off your hands for $5 million and cancel the $20 million in back-end milestone payments we owed on Ana Paula. They agreed. So everything you see in Alaska, we picked up for $15 million in cash. Kind of an incredible transaction in hindsight, and one we're not likely to repeat on that magnitude again. But again, just the right time, right scenario, right contrary view on the geopolitical risk in Mexico, and the right familiarity with the right players in the industry. So it's something that all kind of came together in a very serendipitous way.
It says here on your website that producing mines are forecast to produce between 31,000 and 41,000 gold equivalent ounces in 2025. Do you have an updated forecast or guidance for 2026?
Yes, we just recently issued that. So we ended up producing 34,000 gold equivalent ounces, if you include the little bit of silver that we produced last year. So hit our guidance number there. This year, we're on track to produce between 50 and 55,000 gold ounces at an all-in sustaining cost, taking the silver as a byproduct credit at around $2,000 an ounce. So again, stepping up in terms of our size of production as our San Augustine mine comes online, and as we were able to finish mining stockpiles at La Colorada and move on to intense residual leaching techniques there to be able to extract gold from the large heap leach that we have to play with at that asset.
I remember when I first started working in media in 2017, late 2017, early 2018. A lot of the producers at the time were operating with a $1,200, or even as low as I've seen $1,000 all-in sustaining cost. What do you think were the major contributors of cost inflation over the last 7 years in the industry?
Yeah, that's a good question. I mean, everything's gone up, right? As you said, gold price is a leader indicator of inflation. Transportation, fuel prices have gone up. So while that's only a small percentage of your on-site costs, you've got to transport everything to site, sometimes from halfway around the world. So that's been a driver of cost inflation. Price of steel's gone up. Labor's gone up. In Mexico specifically, is everywhere has a union in one way or the other. Those union contracts are governed by the federal government, and your contract rates are renegotiated every year and tied to inflation. So you see kind of this incremental step up again in labor costs, which are a large part of your cost structure at a mine. Everything's gotten a little more expensive. It's hard to say there's one thing in particular, but it has continued to creep up over the last few years. And when you're talking about a $1,200 AISC at that time, what better question is, what was the gold price as well, right? What sort of margin was that $1,200 AISC providing? That's when gold was probably closer to $1,700 an ounce. So it's that percentage margin. I think that's the more important component to focus on.
Now, with better margins today, investors are wondering how you're capitalizing on better margins to deliver even higher shareholder value. How would you add to shareholder value even with current margins?
I think it's through our growth. I think that's where Heliostar is really so unique. We were thinking about this at the Denver Gold Show, listening to these major producers talk about their business plan. Where they're going to make an incredible amount of money over the next few years through this part of the cycle. No, they're probably going to issue some dividends. At some point, as we mentioned, they'll probably overpay for an acquisition, but they'll cycle essentially the same company as they went into it. At Heliostar, we're really able to capture the tailwind provided by the gold price and come out the other side as a materially larger, materially more robust company, having executed on these growth initiatives with the cash generated and afforded to us by this part of the gold cycle. And I think that's really where we add shareholder value. As I mentioned, we're going to go from call it round number 30,000 ounces last year, up to 300,000 ounces by the end of the decade. If you look at any other company operating in that 200 to 300,000 ounce a year range at a bottom half, cost profile, that's a $2 to $3 billion market cap company. As you mentioned, opened with about 750 million market cap. So I think we've got a long way to go to re-rate on scale on our growth as we deliver and de-risk our growth that we promise to investors.
So your ambition is to nearly 10x or 9x your current production profile. Is that mostly going to come from Ana Paula or something else as well?
Ana Paula will be a big piece of it, definitely. I mentioned additional opportunities at the La Colorada mine to expand one of the central pits. So that'll afford us additional growth of that asset. And then our Cerro de Gallo project, which we intend to build after Ana Paula, will add, again, about 90,000 ounces to our production profile, bringing us, again, just shy of that 300,000 ounce a year mark. And then, part of it is inorganic growth. We're hoping to find the right opportunity. Our target is 300 to 500,000 ounces. To get to the upper end of that range, we'd have to buy something. You can do the math. And we think as we continue to see opportunities now, as we continue to re-rate on scale and have more clout, we'll be able to find those opportunities to get there.
And just on Ana Paula, can you give us a sense of the timeline to production and the CapEx number required?
Yes, we're right now working on a drill program that'll inform a full feasibility study. We intend to have that out in the first half of 2027 and use that as a basis for our investment decision, which we think it will be positive. Our latest study showed an initial CapEx requirement of 300 million US. Again, round numbers, we expect to be able to generate about 100 to 150 million of that through internally generated cash flow, with 100 to 200 million required from a project finance facility of some type. From there, it's about an 18-month build timeline. So we expect to have first production from Ana Paula in the second half of 2028, ramping up to that 100,000 ounce a year steady state production run rate by the end of 2028.
How much cash does the company currently have on this balance sheet?
We finished December 31st with $41 million US cash on our balance sheet.
So you still need roughly 100 million more for the 150 million.
60 to 100 million, that's right.
And that's going to come primarily, that's going to come from internal cash flow operations and then generation, and then the remaining 150 for the 300 million will come from financing. Is that correct?
That's correct. Yeah, we see the ability to generate cash from our two producing mines, again, through those series of staged projects, with a good chunk of it coming in 2027 as we do the open pit cutback, do the waste stripping this year, and then be able to harvest that the cash flow from the ore next year.
I'm not saying this will happen, but suppose gold were to, let's say, fall 50%. Which it has done by historical precedents. It's fallen by the order of 40 to 50% after its peak before 1980 and 2011. So suppose that were the case, what would change, if anything, with your timeline for Ana Paula or other projects you have planned?
Sure. In that sort of worst case scenario, I think there's a number of longer dated growth projects we're spending money on now that we would ease off on in order to conserve cash. I think potentially the timeline for Ana Paula, to bring Ana Paula into construction, could be lengthened. Again, we still have visibility, even at those sorts of prices, we'd have visibility on cash flow over the next few years, but it would obviously take us much longer to generate the sort of equity, internal equity we'd want to be able to put towards that construction build. Or again, we might have to look at raising equity in the markets to be able to fund it. If gold were to pull back to a $2,000 gold price. Again, obviously our all-in sustaining cost this year is $2,000, so we wouldn't make any money. So we still would think there's value in bringing Ana Paula into production. With a $1,000 AISC, it would still make money at a $2,000 gold price. So I think there's still ways we would be able to continue to create value even in that dramatic worst case scenario.
Well, this is your company's stock. So Heliostar is up just from 2024. It's up about 1,100%. So I don't have to say this, but it's far outperformed the metals themselves. So I wonder why you're not taking advantage of this current environment to raise more capital now, knowing you'll have to raise at some point in the future anyway. Why not just front load that raising now while the price is still high, while gold's still, soaring, and while investor appetite is still basically frenzied, and your stock is up 1,100% in the last year and a half?
Yeah, I'd argue that we have to raise capital. I don't think we do. I don't think we do have to
Okay.
raise equity. I think that's
Okay.
the first. I kind of reject the premise there, quite honestly.
Sure.
The other thing is we're a very different company than we were where that price appreciation starts. We were a struggling single asset developer with a small project in the Aleutian Islands in Alaska. We're now a gold producer. So while our stock has run up a lot, it's a dramatically different picture. The other thing I'd point to again is our relative valuation. A lot of that is been torqued to gold price, and that's great to see and great to have. But we're still only trading at around a 0.3 times spot PNAV. So equity being issued, would still be dilutive on if you run the math. Certainly, if we needed to raise equity, it's a lot cheaper at, just around $3 where we're trading around today versus, 12 cents, I think where that started. But it's certainly not something that we think we have to do. So that's why we're not doing it.
Okay. Well, that at least speaks to confidence in the PNAV of the company. So, all right. Finally, you mentioned that you are interested in buying something at some point in order to expand. Can you just give us a list of criteria in terms of what kinds of projects you're looking for when it comes to jurisdiction, size, grade, geology, so on and so forth?
Sure. I think we like to remain gold focused. I think that's the core of our company. If it comes with a good silver kicker, that's great too. I don't think we're looking to specifically diversify into copper or anything else like that. Never say never, but certainly not our focus. I think geography wise, I call it reasonable Americas. So that to me is, fully permitted in Canada. Our slogan is speed, grade, and growth. The first one of that is speed. Unpermitted in Canada just takes too long. We're not able to suffer that. Along the permitting pathway in the U.S. has certainly sped up timelines down there in some of the good jurisdictions, and we are seeing some projects, that are of interest there. And then, reasonable South America. So Chile, Peru, Argentina, Brazil, Mexico will of course always be a prime hunting ground for us. We're probably not going into Colombia, Venezuela, or Bolivia anytime soon. So again, the better, more prominent mining jurisdictions in the Americas. Outside of that, I think it gets difficult to manage the business. You end up with different operational units. You end up with time zone issues trying to manage with a central management team, operations all over the world. We're still a relatively small company. And like the fact that we're a small, tactical, nimble team, we don't want to grow that bureaucracy. So again, within those, call it 4 or 5 time zones that cover North and South America. In terms of criteria, we're looking for ideally producing asset, something bigger and better. I don't think we just want to collect, small, let's call it, 20 to 30,000 ounce a year producers. We'd like to continue our upward trajectory in scale and quality there, 100,000 ounce a year plus producing asset. We'd like to pay nothing for it, but that's unrealistic. The other thing, we'd look to add is projects to our pipeline, something that, potentially might be better than Cerro de Gallo, something that could come on after Cerro de Gallo. So looking at those sorts of projects, again, in that, call it 100,000 ounce a year plus range. And the third criteria I'd say we look at is cheap ounces to add at the end of our development pipeline. If we can pick up, call it earlier stage ounces that we like the geology of for, I'm just throwing a number out there, $50 to $100 an ounce, something like that, that we have time to work into our production pipeline and to be able to surface value from. I think that's something else we'd look at. Now, whether or not that would require equity at that scale, maybe not, but certainly something else we'd use to flesh out the pipeline.
Okay, excellent. And final question I have for you. After working as VP of Investor Relations and Development for Heliostar, what are some of the things you've learned about the industry, mining in particular, that maybe you didn't know before when you were working as an analyst?
I think one of the things that's become apparent is all the hard work that goes into the polished finished product that's presented to the market and presented to analysts. There's a lot of internal, debate in a good way around what we should do, what we like, how to get things done, what's realistic, all of those things that kind of go through the sausage grinder to produce a nice packaged product and a press release or a feasibility study that goes out to the market. Really appreciating that. I think the other thing too is especially because I was on the research side, seeing a bunch of the M&A opportunities that are floating around out there. I know bankers typically see a lot more of that, but just the number of tires to be kicked along the way, with only a finite number of hours in the day to do it. So you've got to kind of pick your spots on where you want to dig in and understand an opportunity or decide to pass. I think those have been the two biggest learning opportunities moving to this side of the business more recently.
Okay, great. Thanks very much. And we'll put the link down below. What can we, of your website? Tell us where we can find your company's information.
Yeah, absolutely. So we're at heliostarmetals.com, or we're on X and LinkedIn and Facebook as well, if you want to follow on those social platforms.
Okay, great. Thank you very much once again. We'll put the link down below, so follow Heliostar Metals there. Take care for now, Stephen. Good to talk to you. See you next time.
Thanks. You too, David. Bye.
Thank you for watching. Don't forget to like and subscribe.